Welcome everyone to this insightful session on homebuyer decision making. Today, we're chatting about fixed rate versus variable rate mortgages. Truly a debate about stability versus flexibility. I'm excited to dive in. So, let's start with fixed rate mortgages. What's the core idea here? Well, a fixed rate mortgage is essentially a home loan where, the interest rate stays exactly the same over the whole term, 15, 20 or 30 years. This means your monthly payment remains constant through ups and downs in the market, offering a level of predictability that's really comforting to many home buyers. That makes a lot of sense for budgeting, especially for families or retirees. But what about the downside? Sure, the downside is that fixed rate loans usually carry a slightly higher initial rate. So, if the market interest rates drop, you could end up paying a premium. But honestly, for those who value security, that minor risk is often a fair trade-off for stability over the long run. I see your point. Now turning to variable rate mortgages, or ARMs as some like to call them, what's the big perk there? Variable rate mortgages start off with a lower initial interest rate, sometimes 1 to 2% less than fixed rate offers. It's like you're saving money up front, which could really help if you're, say, planning to be in your home for just 5 to 7 years. Right. And if the rates drop later, those payments could go down along with them, making it an attractive option for, let's say, savvy or flexible buyers. But then, the risk here is that if rates go up, your payments can jump. Isn't that a big concern? Exactly. And that's one of the core challenges. The possibility of a payment surge after the initial period can really throw off your budget if you're not prepared. That said, these loans typically have adjustment caps, like a 2% per period and around a 5% lifetime cap to contain extreme fluctuations. Now, honestly, while the fixed rate option provides reliability, isn't it a bit too conservative in today's dynamic market? I appreciate that point, but consider this. For risk-averse buyers, especially those on a fixed income or who plan to keep their home for over a decade, the assurance of unchanging payments trumps the potential gains from lower initial rates. It's a bit like choosing a steady and reliable engine over a sports car that might run out of fuel unexpectedly. Yeah, I see it that way too. Yet for younger buyers or those who expect regular income growth, the lure of lower monthly payments from a variable rate mortgage can really free up cash flow for, say, investments or home improvements. True, and that flexibility is exactly what variable rate proponents argue for. It's all about aligning your mortgage choice with your personal financial trajectory. Right. So, it really boils down to individual circumstances. Are you in it for long-term stability, or can you gamble a bit on market trends for upfront savings? Absolutely. Whether you lean towards the fixed rate for peace of mind or opt for the variable rate for potential savings, it's a decision that should match your financial goals and risk tolerance. Thanks for the enlightening discussion. It's clear that both options have merits, and understanding these trade-offs is key for any prospective homebuyer. Exactly. And thinking about it, it's like choosing the right tool for a job. Make sure you pick the one that fits your specific needs. Well said. That wraps up our chat. Until next time, happy house hunting.